is basically an average of the two. Okay, average costing system, the focus would not be on cost of goods sold transaction, but rather on purchases cycle. Okay, meaning that this equation here basically is very simple when we go into inventory record. Basically what we're trying to do is we're not assuming customers either purchasing from earlier ones or later ones, not by the sequence, but every time when we have new purchase inventory transaction, we would do an average cost and figure out what is the average price, let's say, for each and every bottle of Coke. So then when customer purchases it, we just use the average price to assign to those bottles that we sell out to customer. So we no longer, if companies uses this method, they don't assume that customers purchasing from earlier batch or later batch. But if they purchase a second transaction, they will be averaging out these two, find an average number. And if they have a third purchase transaction, then they will be averaging out all three numbers here. Okay, so by averaging, they will total up the cost on inventory and divide it by the total units that they have to find an average cost per product. And they use this average cost per product times the product that they're selling to customer. So later when we look at the cost, the overall cost of goods sold number, average cost would always has a number that's somewhere in the middle of LIFO and FIFO. Because every time it averages out the cost per unit whenever there's new purchase transaction. Okay, the bottom note here on this slide is useful for all three methods, not just for average cost. So here I just want to point out that the cost of purchasing goods is the same. This part here, inventory cost, is always the same. We're just trying to divide which part is cost of goods sold, which part is ending inventory. So there will be differences when you look at statements for companies if they use FIFO, if they use LIFO, if they use average cost. You will see slightly a difference between cost of goods sold numbers for these three methods, and also a difference for ending inventory for all three methods. Okay, this is just a way how we measure inventory cost as we sell, as merchandisers companies sells products to customer, just a way to measure it. So again, ideally the case would be actually tracking each and every bottle, whether it's from the earlier purchase batch or latest purchase batch. But oftentimes, on a daily basis, there are thousands of transactions coming into the company, going out, being purchased, being sold out. So usually this is the way how merchandisers' business measure up the costs when they assign to the products that customers are purchasing. Okay, let's take a look at that example again. Now we start from ending inventory, 2 units at $40, and now we purchase 6 more units at $45. Okay, so for average costing system, the key point here is take a look at all the purchase transactions. Whenever there's new purchase transactions, we will need to average out a unit cost, which is the red number here. Okay, so how we get to this number, we will use earlier ending inventory, the $80, plus the new inventory that you're purchasing in, $270. 80 plus 270 will give you $350. This is the total inventory purchase cost. Okay, once you have the total cost, then just divide it by how many bottles that you have, or how many DVD sets that you have. So if this is the total cost of all the DVD sets, we just divide it by 8 to figure out what is the unit DVD cost. So for each DVD set, the unit cost is $43.75. This is the process of averaging out the inventory cost. So when we're now selling 4 DVD sets to customer again, how do we assign the cost here? Not based on earlier, not based on latest, but directly based on this average cost that you just calculated. Okay, when companies use average costing systems, when you start selling the products to customer, then you just use the average cost that you calculated for earlier purchase transactions. Okay, so you'll not be using 40, not using 45, but using 43.75. So after the selling transactions, ending inventory, the same thing. We use this red number here times 4 units because you sold out 4 and you still have 4 left. But both of them will be using the average cost that you calculated to assign the cost to cost of goods sold and inventory. Any questions so far? Okay, what happens if there's new purchase transactions? If new purchase transactions 9 at 47 units here, and whenever there's new purchase transactions for average cost method, you have to calculate a new red number, new average cost for each product. Okay, so this 9 DVD sets, you include it in the left side purchase transaction column. But then we will use this total 423 plus ending inventory 175, total cost divided by total units, 13 units, to figure out a new average cost for each product. Okay, again, what this is, step 1, you always calculate what is the total purchase cost. So you will have a new set of purchase costs, and then you add up what's left in your warehouse earlier before this transaction. So earlier we had $170 left. Now you add in 423. This is the total inventory cost that you have in your warehouse, then divided by the number of items. So you have 13 DVD sets divided by 13. If there's 12, divided by 12. Okay, but basically don't forget to add these two. These are the total costs divided by 13, so each and every unit cost, if you spread out the cost, each and every DVD set costs 46. So this will be the new average cost that you use if later on the company sells an additional transaction. Let's say they sell an additional 5 DVD sets. You'll not be using 43.75, but you'll be using 46. Okay, so next selling transaction, it will be whatever number of sets that you're selling times 46. And then ending inventory would also be subtracting what you sold out, what's left, times 46. Now it's always good to double check that this number has to be somewhere between these two. Okay, if you average out a number that is higher than the larger number, then that basically means there's something wrong when you calculate the average cost. So always make sure that this number, the average method, since it's already called average, it has to be somewhere in the middle of those two numbers, between 43.75 and 47. Okay, let me just go over the step again. For this method, is a little different from LIFO and FIFO. We're not choosing earlier cost or latest cost. Whenever there's new purchase transaction, we would average out, find an average cost for each and every product that we have in our warehouse. So to do this, we will add up original ending inventory plus any new purchases, add the total cost up divided by the total units that you have now, which in this case is 8. So you figure out an average cost per unit. When you start selling the items, you just use that red number to assign the cost to those items, and also use that number for ending inventory. And the key point for this method, again, whenever there's new purchases, you have to do this process all over again. So So when there's new purchase transaction, and specifically this dollar amount is very different from this average cost that you just calculated earlier, we do this average cost process again. So you add up 423 with what you have, 175, and again divided by the total number of sets. Okay, so this will be the new cost. Whenever there is new sales transaction, you will use 46, and ending inventory also 46. Okay, once again, the last step here. Add up this with this. 175 plus 598. If you're quick in calculation by mind, you can probably tell that the number is actually exactly the same as FIFO and LIFO. 175 plus 598, you still have cost available for sale, 773. Okay, so regardless of the methods, what we're trying to do is just divide up the cost between the two, but the total amount is always the same. This was the total purchase cost that occurred before. Okay, journal entries here. All the purchase transactions is the same. Again, when we assign the cost to cost of goods sold to customers' purchases transaction, you see 4 at 43.75. So remember FIFO, 2 of them was at 40, 2 of them at 45. LIFO, all 4 was at $45. Here, average costing, you see a dollar amount, 43.75, which was this part of the transaction. When we first used an average cost, if you have follow-up transactions, then you'll be using 46. But earlier we used 43.75. So this is the part that we journalize in this journal entry. Okay, so for FIFO earlier we had 170. For LIFO we had 180, and here we have 175. So average costing method is always, when we assign the cost, it will be somewhere between the two, between LIFO and FIFO. Okay, any questions?